Hello students, today we are going to discuss about another topic of business management. The topic name is capital market. Now let's begin with the meaning of the term financial market. Financial market are the centers or arrangements that provide facilities for buying and selling financial claims and services. Primary markets. The primary market, also known as direct market, deal in new financial claims or securities and as such are also known as new issue markets. Primary markets mobilize savings and supply fresh or additional capital to business units. Secondary markets deal in securities already issued or existing or outstanding. The secondary markets contribute indirectly to the supply of capital by rendering liquid securities issued by the primary markets. Money markets. The money markets is a market in which transaction in short-term financial assets takes place. Short-term financial assets are those assets that can be readily converted into cash or have a maturity period of less than 1 year. What is capital markets? Capital markets deal with financial assets which have a maturity period of more than 1 year. Financial instruments. Financial instruments can be described as the way in which the financial system of the country deals in. There are various types of financial instruments and they differ from each other in respect of their investment characteristics. Financial instruments can be very broadly classified into two categories. A. Financial assets. Financial assets represents a claim to the payment of the sum of money sometime in future and or a periodic payment in form of interest or dividend. Second one, financial securities. It can be classified into primary and secondary securities. The primary securities are issued by the ultimate investors directly to the ultimate savers as ordinary shares and debentures, while the secondary securities are issued by the financial intermediaries to the ultimate savers and bank deposits units, insurance policy, and so on. Functions of financial market. The important functions were A. Mobilization of savings and channelizing them into the most productive uses. A financial market facilitates the transfer of savings from savers to investors. Second one, facilitating price discovery. The forces of demand and supply helps to establish a price for a commodity or service in the market. The interaction between them helps to establish a price for the financial assets which is being traded in that particular market. Third one, providing liquidity to financial assets. Holders of assets can readily sell their financial assets through the mechanism of the financial market. The fourth one, reducing the cost of transaction. Financial market provide valuable information about securities being traded in the market. Instruments of financial markets. Call money. Call money market is that part of national market where the day-to-day surplus funds, mostly of banks, are traded in. The loan made in this market is of short-term nature, their maturity varying between 1 day to fortnight. As these loans are repayable on demand and at the option of either the lender or the borrower, they are highly liquid. Their liquidity extended only by cash. Treasury bills. A treasury bill is a particular kind of finance bill or a promissory note issued by the government of the country. Treasury bills are highly liquid as they carry the guarantee of the government, and because the central government of the country is always willing to purchase or discount them. The treasury bills in India are of the following types: 91 days treasury bill, 182 days treasury bill, and 364 days treasury bill. In Indian context, treasury bills have traditionally carried the lowest rate of interest as compared to other instruments. Treasury bills have an impact on monetary policy because of their unique nature. Minimum value of one treasury bill is rupees 25,000 or its multiples. Commercial bills. A bill of exchange is used to financing a transaction in goods that takes some time to materialize. It shows the liability to make the payment on a fixed date when the goods are purchased on credit. A bill of exchange is treated as a self-liquidating paper. It carries a low degree of risk of loss and is an asset which is shiftable. Commercial bills can be classified into two types: demand bills and usance bill. A demand bill is payable on presentation, and the usance bill is payable at a specific date later. Traditionally, trading instruments like hundis are classified as commercial bills. Commercial papers. These are short-term promissory notes with fixed maturity issued mostly by nationally reputed, credit-worthy and highly rated corporations. The commercial papers market is comparatively small in India, and the issue of commercial paper is regulated by our Central Bank of India under strict guidelines. Certificate of deposits represents bank deposits account which are transferable from one party to another. They are marketable or negotiable short-term instruments in bearer form. Certificate of deposits are virtually riskless in terms of default payment of interest and principal. Certificate deposits were introduced in India in 1989. As per the RBI rules issued in 1990, the minimum denomination of certificate of deposits was rupees 10 lakhs, and the minimum size of issue of certificate of deposit to a single deposit was 50 lakhs. It is estimated that the commercial banks in India have a potential of issuing certificate of deposits worth rupees 7,500 crores, but this potential has been underutilized as India lacks an active secondary market for trading in commercial deposits. Government securities, or sometimes we may call it as gilt securities. The supply of government securities stems from the issue of government marketable debt. These securities can be issued by the central government, state government, semi-governmental agencies and authorities like city, corporation, local municipalities, etc., and other governmental agencies such as IDBI, IFCI, etc. The government securities are unique in the sense that it is held by the central bank of the country on behalf of the government body. As such, the government securities play an important role in the monetary policy regime of the central bank, especially in the case of open market operation and the statutory liquidity ratio. Ordinary shares. These are ownership securities which have certain advantage in favor of issuing companies and investors depending on their attitude of risk taking. Ordinary shares allow the general public to invest in the company of his choice and participate in the earnings and wealth of the company without limit. On the other hand, ordinary shares allow the companies to raise capital quickly and help to avoid interest payment burden, as dividend payment are not mandatory here. Ordinary shares in India generally have a face value starting from rupees 10. Preference shares. Preference share is an instrument similar to an ordinary share but carries a fixed rate of return. The holders of preference shares are entitled to income after the claim of the creditors of the company have been met, but before ordinary shares receive any income. Because of this clause of mandatory dividend, various types of preference shares are found in the market. Foreign exchange market. It's a market in which national monetary units or claims are exchanged for foreign monetary units. According to FERA Act 1973, foreign exchange means foreign currency, and it includes all deposits, credit, balance payable in any foreign currency and instruments payable either in part or in full in foreign currency. Foreign exchange markets are cleared at a conversion price, that is the exchange rate. Although the exchange rate is apparently determined by the supply and demand for foreign exchange, the complex forces of export and import lies behind the whole process of exchange rate determination. In this context, two definitions are important: devaluation and depreciation. Devaluation means a deliberate reduction in the value of domestic currency with respect to a foreign currency. Classification of capped market. Capped markets divided into two parts. What are they? Primary market and secondary market. Primary market is also known as new issue market. It deals with new securities being issued for the first time. The main investors are banks, financial institutions, insurance companies, mutual funds, and individuals. The different methods of flotations in these markets were offering through prospectus, that is, adopted public companies to raise funds directly from public, offer for sale through intermediaries. Issue took place at an agreed price. Private placement, allotment of securities to institutional investors and some selected individual. Right issue, the privilege given to existing shareholders to subscribe to a new issue of shares. Electronic IPOs. Nowadays, electronic version applied for exchanging securities virtually to save time, cost and effort. Stock exchange or secondary market. Securities Contract Act 1956 defines stock exchange means any body of individuals, whether incorporated or not, constituted for the purpose of assisting, regulating or controlling the business of buying and selling or dealing in securities. The various functions of the stock exchanges were: A. Providing liquidity and marketability of existing security. B. Safety of transaction. C. Pricing of securities. D. Contributes to economic growth. E. Spreading of equity cult. And F. Providing a scope of speculation in the economy. Trading and settlement procedures in stock market. The following steps are involved in the screen-based trading for buying and selling of stocks and securities. First one, the investor has to sign a broker-client agreement and furnish or provide the details of PAN number, date of birth details, qualification, professional experience, residential status, banks and depository details, name of broker, client, code number in registration form for smooth conduct of trade. Step number 2, The investor has to open a demat account with the depository participant for holding and transferring securities. Step number 3. The investor then places an order with the broker to buy or sell shares or take trade activities directly. Step number 4. The broker then will go online trading facility and connect exchange and match the share and best price available. Fifth step. When transactions took place, the broker will issue a trade confirmation slip to the investor. Step number 6. After the trade has been executed, within 24 hours, the broker issue a contract note. Step number 7. Now the investor has to deliver the shares sold or pay cash for the share bought. Step number 8. The settlement cycle is on trade transaction plus 2 on a rolling settlement basis with effect from 1/4/2003 onwards. Step number 9. On the T plus 2 day, the exchange will deliver the share or make payment to the other broker. Finally, the 10th one, the broker can make a delivery of security in demat form directly to the investor's demat account. Now, what is a depository? Who is a depository? A depository is like a bank and keeps securities in electronic form on behalf of the investors. It is a technology-driven electronic storage system. It has no paperwork relating to security dealings. In India, there are two main depository institutions are there. They were NSDL and CBSL. NSDL means National Security Depositories Limited. CBSL represents Central Depository Service Limited. Both these institutions operate through intermediaries who are electronically connected to the depository and serve as contact points with the investors and are called depository participants. History of stock markets in India. The first stock exchange in India was set up in 1875 as the Native Shire and Stock Brokers Association in Bombay. Today it is known as BSE, Bombay Stock Exchange. This is followed by other places in Ahmedabad in 1894, Kolkata 1908 and Madras in 1937. A lot of crises were faced by Indian stock exchanges in early 1980s, which were resolved by the reforms in 1991. The result acquired a three-tier form in our stock markets. They were Regional Stock Exchange, National Stock Exchange and Over-the-Counter Exchange of India. NSE, National Stock Exchange. It was incorporated in 1992 and was recognized as a stock exchange in 1993. It started operation in 1994 with trading on the wholesale debt market segment. The NSE was set up by leading financial institutions, banks, insurance companies and other financial intermediaries. It is managed by professionals who do not directly or indirectly trade on the exchange. The objectives of NSEs were establish a nationwide trading facility on all types of securities, providing a fair, efficient and transparent security market using electronic trading system, meeting international benchmarks and standards, establishing shorter settlement cycle and book entry settlements. BSE, Bombay Stock Exchange Limited, was established in 1875 and was Asia's first stock exchange. It has a global reach with customers around the world. It has stimulated innovations and competitions across all market segments. The exchange has about more than 5,000 companies listed from all over the country and outside, and has the largest market capitalization in India. The important terms in BSEs were Sensex, which means the Bombay Stock Exchange Sensitivity Index. The Sensex was launched in 1986, is made up of 30 most actively traded stocks in the market. In fact, they account for half of the BSE's market capitalization. They represent 13 sectors of the economy and are leaders in their respective industries. SEBI, Security Exchange Board of India. This institution was constituted in 12th April 1988 as an interim administrative body to promote orderly and healthy growth of security market and for investors' protection. It was functioned under the control of Ministry of Finance of the Government of India. Reasons for the establishment of SEBI. Due to good progress in early 1980s, the share market witnessed increased participation of the public. Gradually, a variety of malpractices started on part of companies, brokers, merchant bankers, investment consultants, and other in the speculation market. Some of the glaring examples of such incidents were rigging of prices, unofficial premium on new issue, non-adherence of provisions of the Companies Act, delay in delivery of shares, etc. Such activities eroded investors' confidence and multiplied investors' grievances. Finally, government decided to set up a watchdog to control the speculative market in India by the name SEBI, that is Security Exchange Board of India. Purpose and role of SEBI. The basic purpose of SEBI is to create an environment to facilitate efficient mobilization and allocation of resources through the security markets. It also aims to stimulate competition and encourage innovations. SEBI's main role were to the issuers. It aims to provide a marketplace in which they can confidently look forward to raising finance as they need in an easy, fair and efficient manner. To the investors, it could provide protection of their rights and interests through adequate, accurate, authentic information and disclosure of information on a continuous basis. To the intermediaries, it should offer a competitive, professionalized and expanding market with adequate and efficient infrastructure so that they are able to render better service to the investors and issuers. Objectives of SEBIs. The overall objectives of SEBIs were to regulate stock exchanges, securities industries to promote their orderly function, to regulate and develop a code of conduct and fair practices by intermediaries like brokers, merchant bankers, etc., to prevent trading malpractices and achieve a balance between self-regulation by the securities industries and its security statutory regulation, to protect the rights and interests of investors, particularly individual investors, and to guide and educate them. Functions of SEBI. There are three types of functions to be fulfilled by SEBI. They were regulatory functions, registration of collective investment schemes at mutual funds, levying fee or other charges for carrying out the purpose of this act, registration of brokers and sub-brokers and other players in the market, regulation of stock exchange, stock brokers, portfolio exchanges, underwriters and merchant bankers, calling for information by undertaking inspection, conducting enquiries and adults of stock exchanges and intermediaries, performing and exercising powers delegated by the central government, regulation of takeover bid by the company, development functions, undertaking measures to develop the capital market by adopting a flexible approach, conducting research and publishing information useful to all market participants, training of intermediaries of the securities market, protective function, undertaking steps for investors' protection, prohibition of fraudulent and unfair trade practices, controlling insider trading and imposing penalties for such practices, promotion of fair practices and code of conduct in securities market. The organizational structure of SEBI. The headquarters of SEBI located in Mumbai. Its regional office working in Kolkata, Chennai and Delhi to attend to investors' complaint and liaise with the issuers, intermediaries and stock exchanges in the concerned region. The SEBI formed two advisory committees. They are Primary Market Advisory Committee and Secondary Market Advisory Committee. Their objectives were to suggest SEBI on issues related to the development of primary markets in India, to advise SEBI on matters relating to ensuring investors' protection in the primary market, to mention SEBI on disclosure requirements for company, to disclose changes in legal framework to introduce simplification and transparency in the primary market, to help board in matters relating to the progress of the secondary markets. These are the various points to be discussed in connection with the chapter financial market. Thank you.